If you've ever looked at a price chart and felt like it was just a mess of lines, candles, and noise, you're not alone. Every trader starts there. But here's the secret: hidden in that chaos are recurring patterns, moments where history quietly rhymes. Recognizing those patterns is one of the most powerful skills a trader can develop, because once you start seeing structure where others see noise, you stop reacting and start anticipating. Today, we're diving deep into pattern recognition in trading, what it really means, why it matters, and how mastering this single skill can completely change the way you see the markets. Pattern recognition is not just about memorizing chart shapes. It's about understanding behavior, the psychology of buyers and sellers being translated into price action. Every head and shoulders, every flag, every wedge. They're all expressions of emotion, greed, fear, hesitation, and conviction, playing out on the chart. As Paul Tudor Jones once said, the whole world is simply nothing more than a flow chart for capital. When you understand that flow, those repeating formations, you gain insight into how market participants are behaving, not just what prices are doing. Let's start with why pattern recognition is such a game changer. When you recognize a pattern early, it gives you predictive power. You begin to anticipate where the next move could go, instead of reacting after the fact. That means you can plan your trades, your entries, your exits, your stop-loss levels, with purpose. Patterns also become the backbone of your risk management. If a pattern breaks its structure, that's your signal to get out. No emotion, no debate, and beyond just signals, pattern recognition is the foundation for many trading strategies, from classical technical setups like triangles and flags to modern algorithmic systems that use machine learning to detect patterns far faster than any human could. Now, in my own experience as a trader, I've seen how easy it is to become overconfident once you spot a few patterns. You recognize a triangle or a double bottom, and you start to believe you've cracked the code. But the truth is, it's not about seeing a shape, it's about understanding the context. Where is it forming? What's the broader market sentiment? What's the volume doing? Without context, a pattern is just a coincidence. Let's break down how these patterns come to life. Continuation patterns, like flags, pennants, and triangles, usually show a brief pause in the middle of a trend. They're like the market catching its breath before another leg higher or lower. When you spot these and the breakout aligns with the prevailing trend, that's your cue to ride the momentum. Reversal patterns, on the other hand, are the market's way of saying, enough is enough. Think of the head and shoulders pattern, three peaks that tell you buyers are losing control. Or double tops and double bottoms, where the market tests a level twice and fails to break it. These are moments of exhaustion, the kind that often precede a big shift in direction. Then you have bilateral patterns, wedges or symmetrical triangles, where the market could go either way. They're trickier but incredibly powerful when combined with volume or momentum indicators. Now, here's something fascinating. Technology has completely revolutionized how traders detect these patterns. What used to take hours of manual chart analysis can now be done in seconds with AI and machine learning. Algorithms can scan thousands of charts and flag emerging formations, but even then, the human element remains irreplaceable. Machines can find shapes, but only experience can interpret the story behind them. Let me share a powerful case study that captures this perfectly. Back in 2008, before the financial crisis erupted, the SP 500 was forming one of the most iconic reversal patterns in trading history, a textbook head and shoulders. It started with a strong bull run in the mid-2000s, then peaked in late 2007, forming the left shoulder. A few months later, the market surged again to a new high, the head, before falling back once more. Then, in early 2008, it tried to rally again, but this time couldn't reach its previous highs, the right shoulder. Traders watching closely could see what was happening. Momentum was fading, and the neckline, that key level connecting the two dips between the shoulders, became the line in the sand. When the index broke below that neckline in June 2008, the pattern confirmed a major bearish reversal. Those who recognized it early either protected their portfolios or positioned short. Those who ignored it, or didn't understand it, suffered enormous losses when the crash hit. By the end of that year, the SP 500 had fallen nearly 40%. The lesson? Pattern recognition doesn't just enhance opportunity, it protects you from disaster. I remember trading through that period. The charts told a story before the headlines did. And that's the beauty of technical analysis, the market whispers before it screams. But even with all this, pattern recognition isn't foolproof. False breakouts happen. Patterns fail. That's part of the game. The key is discipline, waiting for confirmation, respecting your stop losses, and never assuming the market owes you a setup. As Bruce Kovner once said, every day I assume every position I have is wrong. That humility, that readiness to adapt, is what separates pattern recognition from pattern prediction. You're not trying to be right, you're trying to respond correctly when the evidence shifts. So, if you're new to trading, start by mastering a few classic patterns. Study how they form, how volume behaves, and how often they fail. Backtest them. Replay charts. Train your eyes until recognizing a setup becomes second nature. It's not glamorous work, but it's what builds intuition, the kind of intuition that turns analysis into instinct. And if you're more advanced, challenge yourself to go deeper. Use technology, blend human intuition with data, and refine your strategy around pattern confirmation, not assumption. Because at the end of the day, trading is pattern recognition on every level, not just on charts, but in behavior, emotion, and probability. The more you recognize, the more predictable the unpredictable becomes. So, here's my question for you. When you look at a chart, what pattern do you trust the most, and why? Is it the simplicity of a double bottom, the precision of a flag, or the narrative behind a head and shoulders? Drop your answer in the comments. I'd love to know how you see order in market chaos.
Thank you for listening to The Disciplined Trader, brought to you by bellsforex.com AudioWorks. We hope this episode gave you insights, perspective, and practical ideas to strengthen your trading mindset and improve your decision-making. Stay disciplined, keep learning, and remember, every trade is a step toward building your edge. If you found value in today's episode, don't forget to like, subscribe, and turn on notifications. Sharing the podcast with fellow traders helps us grow and bring even more free trading education to the community. Visit us anytime at bellsforex.com for resources, guides, and tools to support your trading journey. Until next time, trade smart, stay disciplined, and keep building your edge. Happy trading.